Hi. I asked a client the other day, we'll call him Jim, about his financial goals and his risk tolerance. And we were talking about the type of investments that would help him achieve those goals. And what Jim told me was that he was behind with respect to funding his future retirement. He had 10 years left until retirement and he was willing to save, but he needed to achieve good investment returns to make it all happen. It was critical. And here's the catch. He didn't want to take any risk. When I asked him what drop in his portfolio value, percentage-wise, over a year could he tolerate, he said, I don't want to invest in anything that could go down. I'm thinking maybe up to 5% or no, just 0% in any of the 10 years between now and retirement. I explained that 10 years was a long time horizon and that we would invest in a diversified portfolio. We'd have quality securities that would have an extremely low probability of losing money over the next 10 years. In fact, a portfolio that would have a high probability of earning probably 5 to 10% per year when averaged out over the 10 years. Jim reiterated, I need a high rate of return, but I don't want to see my investments go down at all ever. I explained that this stance could be very costly for him. Have you ever found yourself worrying endlessly about the next market downturn, altering your investment strategy out of fear? Well, you're not alone. Many investors spend sleepless nights over potential market crashes, inadvertently making costly mistakes. Peter Lynch, who's a famous portfolio manager, I don't expect you to know who he is, but he was big with Fidelity in the States for a long time, and he said far more money has been lost by investors preparing for corrections, which is a 10% decline or more in the market, or trying to anticipate these corrections than has been lost in the corrections themselves. This is a powerful statement and highlights the paradox that many people face. The fear of loss leads to missing out on potential gains. But did you know, historically, stock markets have been a significant wealth generator across the globe for many people. Despite pessimistic tendencies, history favors the optimist. From data stretching back to 1629 for the UK and the Netherlands to a French company's records showing the data going back to 1372, research shows that the long-term real return for stocks has hovered around 5%. Now, real return just means this is the long-term return less the inflation rate. So in a sense, the return is 5% plus inflation. This persistence showcases the triumph of optimism and the tangible cost of pessimism. Being pessimistic is more common than being optimistic. Why? Well, I believe it's because pessimist sounds smarter. It seems more intellectually captivating, and people pay more attention to negative outlooks than positive ones. It's crucial to acknowledge that investing in stocks isn't devoid of any risk. I mean, short-term volatility is a given, and real-term losses over an extended period of time are possible. Yet, if you're diversified and you have a discipline about it, you've historically been rewarded handsomely for staying invested in stock markets. So the concept of myopic loss aversion explains why frequent checks on investment performance can lead to conservative investment choices and lower returns. So what do I mean by that? People so worried about losses that they're constantly checking their balance typically make bad decisions. This short-term focus detracts from the longer-term potential of their stocks. The other big thing is media coverage plays a significant role in shaping investor sentiment, often skewing towards pessimism following market downturns. Take a look at this clip featuring Jerry Seinfeld.
To me, the most amazing thing about the news is that whatever goes on in the world, it exactly fits the number of pages that they're using in the paper that day.
Interesting concept.
I mean, I don't know. They must stand around after each edition going, I don't believe we just made it again. You know what I mean?
Just filled it up.
Yeah. If one more thing happens, we're screwed. There's no more room in this paper.
It's true. They would fill up their pages or fill their website or app feeds with negative news to get clicks. This negativity bias influences investment decisions, leading to an underallocation in stocks at potentially the worst times when markets have already gone down and a significant amount of the risk has already been shaken out of the market, and it's presenting a really great investment or opportunity to get into the market. Research shows that the media has an asymmetric effect on crash beliefs. Articles with negative sentiment increase the belief in crash, while positive articles have no effect at all. When the market goes down, the media focuses on it disproportionately, and then people invest less. An important behavior to notice is that after stock markets crash, guess what happens? Investors' expectations of future stock market returns become even more pessimistic, even though that would be better for them to go into markets at that time and not be selling them. Morgan Housel, a financial author, wrote this book, Same as Ever. And in it, he had a very interesting chapter called Overnight Tragedies and Long-Term Miracles. And the idea is that tragedies tend to happen very quickly, while miracles take many years to materialize. For example, he talks about heart disease. If we hadn't had any advancements in heart disease treatment since 1950, 25 million more Americans would have died over the last 65 years. And the crazy part about that stat is that if you look at the average annual decline in heart disease mortality from, say, 1950 to 2014, it was 1.5% per year. 1.5% less deaths per year. Hardly going to catch some eyes when it comes to a news headline. So the idea is that bad news travels very quickly and happens very quickly. Things like Pearl Harbor, 9/11, COVID-19, these things hit and they hit hard. But the best stories, the good news, it tends to not be newsworthy. So how can investors combat this ingrained pessimism? Well, one effective strategy is to reduce how often you check your investments. Another one is automating or delegating portfolio management so that you can help stay the course, focus on long-term goals rather than short-term fluctuations. So the top two strategies are as follows. One, dollar cost average. That's a fancy term for just putting your money in on a regular basis. You can set it up automatically, weekly, monthly, whatever you'd like, and just have it constantly going in. That way, when markets go down, you're buying at those lower prices. Secondly, don't check your balance too often. You know, Warren Buffett's right-hand man, who just recently passed away, is Charlie Munger, and he often said the best investor is the person that lost their password to their online account. Don't check your balance too often. This is important because the common behavior amongst most investors is called myopic loss aversion. Researcher John List found that people who check their investments more frequently tend to invest less in risk assets like stocks and ultimately earn lower returns. So my client Jim, he is overly pessimistic in general. He worries about short-term returns. He's overly influenced by the financial media, which overly represents negative events and outcomes. And he overestimates the probability of an impending market crash. And in the end, it's going to cost him enormously if I can't talk him into adopting a better set of beliefs. Wish me luck. In the end, understanding the cost of pessimism isn't just about acknowledging the losses tied to fear. It's the fear-driven decisions. It's the decisions that come out of fear. It's about recognizing the power of optimism and staying disciplined to your investment strategy. Remember, history has shown us that investing, not only does being optimistic pay off, it is essential for long-term wealth generation. So choose to be optimistic, invest wisely, and let's let time work its magic. Thank you.